This chapter will be covering accounting for partnerships and also LLCs or limited liability companies. These are our learning objectives for the chapter. So if you are starting a business, a lot of times you start in that first form as a sole proprietor or in a proprietorship. As you get bigger, you will probably want to become incorporated. Again, most of our large companies are incorporated. A partnership is similar to a sole proprietorship, except for you have two or more people who come together. And either proprietorships or partnerships, they could both form as limited liability companies or LLCs. Those are very common in today's market because it kind of combines the benefits of being a sole proprietor with being a corporation. So again, the sole proprietor is just owned by an individual. So again, if you provide services like you're an attorney, an architect, a realtor, a physician, if you are in home improvements, lawn care, things like that are examples of people who do sole proprietorships. And the characteristics are that they are very easy to form. The one of the disadvantages is that there is no limit on your legal liability. So you personally, if you're that small business owner or that sole proprietor, you're liable for all the debts and any legal claims that come against the business, and none of your assets are protected. So your house, your savings, your 401k or your retirement package, any of that stuff. The business itself is not taxable, but the sole proprietor would prepare a Schedule C on their tax forms and then would pay taxes through their individual tax return. It's obviously linked to the owner themselves, so when they die, the sole proprietorship would cease to exist. And then you can only raise funds that you could get on your own. A partnership is going to have a lot of those same advantages and disadvantages, but it's where two or more people come together. So again, those are going to be used widely, again, as long as there's multiple people in that business. So the characteristics is that you should have a partnership agreement, again, because it's two or more people coming together. And in that partnership agreement, it's going to talk about things that relate to accounting, such as how much partners are able to withdraw, how is the income and the expenses, income less expenses, distributed to the owners. What happens if we want to add somebody, or what if somebody wants to get out? What if they leave their money invested in the partnership? Can they get paid interest on that? So all those things are going to be covered in that partnership agreement. But then these things are the same as a sole proprietor. So there's no limit on your legal liability. So the partners are going to be personally liable for any debts or legal claims. And again, none of their assets are protected. They could come after their home, their savings, whatever they have. The partnership itself is not taxed separately. It does fill out its own tax return. It's a 1065, but then that net income from the partnership is going to funnel over into the individual's tax returns via a K-1. So again, though, it's still just paid taxes on the individual tax return. It has also the limited life. When the owner dies, that partnership is going to cease to exist. And again, it's limited from raising capital. It's just going to be subject to whatever the partners are able to get. They do have co-ownership of any partnership property, and they also would have co-responsibility to any debt that's assumed. There is a mutual agency, meaning that one partner could act on behalf of the others. So say one partner goes out and signs a lease. Well, now all the partners in that partnership are liable for that lease, or goes out and buys a car in the partnership's name. They're all going to be liable for that. And then again, the partnership agreement should talk about how that net income is allocated. If it does not, it's going to be assumed that it's divided equally. So if you're going into a partnership, you definitely, I feel like, want to have that spelled out. Limited liability companies are the latest and greatest. That's what most people are doing. You can be a single member LLC, or you can have multiple members. So really, people who are sole proprietors or partners can go into this LLC. So it still requires like that agreement between the members that is going to discuss how, what if I leave the money in? Do I get interest? How much can I withdraw? How do we distribute the net income? What happens if we admit or withdraw new members? Now, this is where it's the combination, the advantage of like a corporation is included in here. An LLC has limited liability. So they're only going to be liable to what is in the company itself. They can't go back after, excuse me, the members' personal assets. The LLC is taxed the same way as either the partnership or the sole proprietor is. So they form a 1065, or they would do a Schedule C on their 1040s. So it's only taxed at that individual level. The other advantage that is similar to a corporation is the unlimited life. So even if the member dies, it doesn't stop the LLC from continuing. They could add new members, or members can withdraw, and it doesn't change the formation of that business. They would have a little bit more ability to raise capital. Again, they're not going to be selling stock and bonds and things like that, but they may be a little more attractive to investors because, again, they're a little more protected legally. So then here, again, they give you a nice little table of those differences. To form a partnership, again, it's fairly easy to do. When we look at it from an accounting standpoint, we're going to look at what assets are contributed by each partner, and then what liabilities are assumed by the partnership, and then what the partners actually, the net of what they're bringing is going to go into their capital account. So if we have these two partners who agree to come together, the one partner has a business that has assets and then has a liability. So then we would record their contribution into the partnership. All the assets come in, the allowance for doubtful accounts comes in, their liability comes in, and then their net asset total is their capital contribution in their capital account. And then accounting for that LLC, again, is the same as the partnership. Again, so you can look at it here, except for we're going to call it member equity. And then it's going to go to owner's capital versus the partner capital account. But the journal entry is still the same. And I'll let you look at those examples on your own. Then we divide the income. So again, like it said, if there's no agreement, it's going to be divided equally. If there is an agreement, we're going to follow the outlines of the agreements. And then sometimes, though, there can be like one of the partners may be more of like a general manager, so there could be services performed, or maybe one of the partners leaves more money in the account and there could be interest given. So there can be different things that drive how this partnership income is divided. So if the partner has a salary, that is going to be something we're going to deal with first. All right, so let's go here. So we've got, assume that there's a partnership agreement between Jennifer and Crystal, and Jennifer gets $5,000, Crystal gets $4,000, and then the remaining net income they divide equally. So our revenues less our expenses gives us our net income that we're going to split. So that's the $150,000. So the annual salary, again, what they gave us was the monthly salary. So we got to multiply that by 12. So Jennifer got the 5,000 times 12, gives her 60,000 a year. Crystal got 4,000 times 12, which gave her 48,000. So out of the 150, the first 108,000 goes to their salaries. And then the 42,000 is what's remaining to be split, and it's split equally. So then that's how we distribute out that income. Yep, so then that's just explaining that. So then here is the journal entry for it, though. So we've got our revenues that we are closing out, our expenses that we're closing out, and then the amounts that go into their capital account. And the LLC is going to be the same thing, except for instead of it being called capital, it's going to be called members' equity. Okay, then if they then pull their money out, So now they're going to make a drawing, or they're withdrawing out of the account. So then in this case, they're withdrawing their whole salary. So then we're going to debit their capital account and then credit a drawing account for each one of them. And again, if it was an LLC, same thing, except for it's coming out of members' equity. Now then this gets into a little more detail. So sometimes that partnership agreement can take the income and say, okay, well, if this one partner leaves money in the account, they should get paid interest on that. You know, their money's worth something. So they'll have the salaries, and then now we'll also have interest, and then the rest will be divided equally. So again, same deal. We've got their salaries. Then here it tells, these are monthly. Then here it tells us this is how much their capital balance is, and they're going to earn 12% interest. Then the rest is divided equally. So revenues less expenses gives us the $150,000 that we're going to split. We give them the annual salary allowance, again, the $5,000 and the $4,000 times 12. Then here we calculate the interest. So Jennifer had $160,000 at 12%, so that's $19,200. Crystal had $120,000 at 12%, so that's the $14,400. We subtract that out. That leaves $84,100 to split, and then it's split equally. So the more detailed you can get into these splits, the more fair it is. And then the journal entry to close it, close our revenues by debiting, close our expenses by crediting, and then it goes into each one of their capital accounts. And again, if it was an LLC, it'd be a members' equity account. Now, in some cases, we may go negative. So let's say their net income isn't as high. So they only had $100,000 to split, and then we really have $141,600 to allocate. So we're $41,000 like in the hole, if you will. Well, then they each share that what you're in the hole by. So it's negative 41,600. They each take their share. So then this is what's going to go into their equity accounts. But notice it's not even enough to cover their salaries. So they really couldn't even withdraw that. But that could happen. But then our journal entry is still the same. Again, it's just a lower dollar amount. Then if we admit a partner, either again, maybe that person's going to contribute assets, maybe they're going to contribute cash or buy out one of the existing partners. So then here again, it just shows you kind of a little chart of that. But when we admit that new partner, we will then say if it's by purchasing the interest of the other partner, the capital of that new partner is going to be transferred from the existing partner. So again, we're just going to switch it from one person's name to the other partner's name. If the new partner is just being added and the other partners are staying, then they're going to contribute some sort of assets into that partnership, and then we're going to create a new equity account for them. Okay, so let's see if we get to an example. So here we have Tom and Nathan sell 1/5 of their partnership to Joe Cantor for $10,000 cash. On June 1st, the partnership had total assets of $120,000 and total liabilities at $20,000. So the net assets are $100,000. Both partners have capital balances of $50,000 each. So then here is our transaction. So let me go back here real quick. So they're letting him into the partnership for $10,000 in cash. So we are taking capital from each one of them, though, and giving it to Joe in the form of the $20,000. Then let me see, that's the same thing with the equity. Let me go back there. What did we do? We didn't deal with his cash yet. But then by doing that, we're taking them down to $40,000 each. And then we're bringing him up to the $20,000. So then here again, yeah, we show these guys going down to capital to 40. He's going up to 20,000. So then when they bring him in, the owner's equity is still 100,000. And then he gets his 20% interest in that, which is what they said. Okay. So then now assume he gets 1/5 and contributes $20,000 cash. So then, okay, so then now the cash comes in and they're gonna debit the cash and they're gonna set up his equity account, his capital account. And then if it was an LLC, it'd be the member's equity. So then here we've got more assets coming in and then we're setting up his capital account. Then anytime a new partner is admitted, we need to adjust their equity accounts or their capital accounts to their current values. And then split that to the existing owners. So we've got, if Tom and Nathan each have the capital balances of $50,000, the balance in the merchandise inventory account is $14,000, but the true value, the replacement value, is $17,000. And they each share the net income equally. So we're going to increase the merchandise inventory up to its fair market value, and then they share in that equity. So again, we're getting it all up to the current levels before we add the new individual into the partnership, so that then the existing partners who helped to build that have kind of cashed in on what they built. Okay, so then here we have, assume that Tom and Nathan each have the 50,000. We've got equipment with $15,000 cost and $4,000 accumulated depreciation. And now it's going to go down though. So it's going to go down in value. It really should be only 10,000, not 11,000. So that's a decrease. So then now they're going to share in that decrease, and then we're going to reduce the values down to what it truly is at that day. So we're going to take that value and just take it down to the 10,000. So we're getting rid of all the accumulated depreciation and then taking the asset down to the $10,000. And then that would be the journal entry if it was an LLC. Okay, then we have partner bonuses. So a new partner may pay an existing partner a bonus to join the partnerships, or the existing partners may pay the new partner to join. So it could go either way. Bonus could be paid either way. So the existing partners receive the bonus received by the new partner. So the existing partners receive a bonus when the ownership interest received by the new partner is less than the amount paid. If the new partner receives a bonus, it's when the ownership interest received by the new partner is greater than the amount paid. So we've got an example. So Marcia and Helen are considering a new partner, Alex. After the assets of the partnership have been adjusted to the current market values, the capital balances show 20,000 to Marcia, 24,000 to Helen, so 44,000 before they admit Alex. And they agree to admit her or him for $31,000. In return, Diaz or Alex will receive 1/3 equity in the partnership and will share equally in the partnership income or losses. So in this case, Alex Diaz is paying Jenkins and Kramer a $6,000 bonus to join the partnership. So we've got their contribution, and then they're agreeing to admit him or her for $31,000. He's going to get 1/3 of that $75,000, which is $25,000. So then that means that extra $6,000 that he paid is going to go as a bonus to Jenkins and Kramer. So then we're going to just put it right to their capital account. So he paid $31,000. He's got a $25,000 capital, which gives him 1/3, and then he's paying to bump each one of them up by that $3,000. Then we got another scenario. If we have Janice and Steve, Janice has 80,000, Steve has 40,000 prior to allowing Ellen to join, and then Ellen's going to contribute 30,000. And then she is contributing the 30,000 to share 1/4 of the equity and 1/4 of the profit. So we add all their equity together. It's a total of 150,000. 1/4 of that is 37,500. So then now in this case, Cohen and Dodd owe Chow that $7,500. So then we're going to take it out of their capital and give it to her. And they're giving it to her based on 2/3 is going to come from Janice and 1/3 comes from Steve. And if a partner withdraws, they're going to normally kind of want their money back out, or they're going to give their interest, it's going to go back to the other partners. So if a partnership purchases the withdrawing interest partners, then the assets will be reduced by that purchase price. So they should first be adjusted, though, to their current market value, and then divided that equally to the partners, and then we'll record an entry to record that. When the partnership dies, the partnership accounts will be closed for that party, and the net income should then be divided into the partner's capital accounts. The assets all should be adjusted to their current values and then also divided to the partner's capital accounts. And then that income would then close out to the deceased partner, and obviously whoever their beneficiaries would be paid. So they'd be paid to their estate. If the partnership's going out of business and then they're going to liquidate, they got to pay all their creditors first, and then anything that's remaining is going to get liquidated back to the partners who are involved. So first they're going to sell the partnership assets, distribute any gains or losses to the partners based on their income sharing ratio, pay the claims of the creditors, and then distribute the remaining cash to the partners based on the balances in their capital accounts. So you always got to pay the liabilities first, and then if there's money left over, it's going to get distributed to the partners. So here we have a post-closing trial balance of a partnership that is liquidating, and then they tell us that it's a 50-30-20 split. All the cash assets are sold for $72,000. So if we look back, it was $64,000 as their value of the non-cash assets. So we have a gain of $8,000, and then all the liabilities are paid. So then if we sold it, we got the $72,000. That gain is distributed based on the 50%, 30%, and 20%. Then we pay off our creditors. So then that leaves $74,000 that then they are going to split into their capital balances. So it's not quite at that split level, though. Let's see. It's not at the 50, 30, and 20. So here they show us, it's at their balances, right? So their balances before the realization. So they each had 22,000 before. Then they added in their gains, so that is what they have in their accounts. So it isn't the exact split of the 50, 30, and 20. It's what's in their partnership accounts. And then this records the sale of their non-cash assets. This records the gain going into their capital accounts. This is the payment of the liabilities that are owed. And then this is the distribution back to the partners, and then all the cash is gone, and then the account is liquidated. Okay. Oh, then this goes the other way. What if they have a loss? So then they sell it for a loss. So again, they split the loss according to their profit ratio. They pay their creditors, and then they only have $46,000 left. So again, they had the 22,000. Now we subtract the losses. So these are the amounts that's left for each one of the partners. So again, we receive the cash, record the loss, then we put the loss to all of the partnership's accounts in based on their income share. Then we pay the liabilities, then we pay off the partners. So obviously now they're getting less money because they didn't make as much money when they sold it. Okay, then what if it ends up with a deficiency where they don't even have the credit in their capital balance? Then that's an actual claim against that partner. So if they now they have a $54,000 loss and all those liabilities are due, so then that $54,000 loss is shared based on their ratio. They still owe the $9,000. So when we look at it here, when they go across, Farley is actually going to owe $5,000. So he's got to pay that up. So here's the loss. Here's the allocation to the partnerships. Here's the payment of the liabilities. Here's where Farley now has to pay in that deficit. He owes the partnership $5,000. And then the other two partners are going to get their money back out. So in a sense, he has to pay it in so that then they can get their fair share at the end. Okay. Now then it says, though, assume that they don't pay. So assume that partner says, hey, I ain't paying that $5,000. Then you have to allocate the $5,000 deficit out to the two partners that are remaining. So the one is going to get $3,000 of it. The other one has to eat $2,000 of it. So then here is what they'll end up getting after if that partner doesn't end up paying. So then that will be their payment, will be the $3,000 and the $2,000. Oh no, that's the split of the deficit. Then this is their payment that they'll get paid out of the cash. And then there's always a statement that shows everything that happened. So what is your beginning year balance? What got added in? How did the net income get allocated? And then what withdrawals were made. And then that's your ending balance in your capital account. And that is always prepared at the end of the period. Then again, we always end it with a ratio. So we've got a revenue per employee. So what is your revenue divided by your number of employees? And that would be the revenue per employee. Okay, so that is our partnership and LLC chapter.